The persistence of core inflation across the developed world at well above central bank targets remained the driving narrative for global markets in the second quarter, leading to further rises in policy rates and significant shifts in market expectations for peak rates and how long they will remain at those terminal levels. This pushed bond yields higher, especially at shorter durations, with 2-year bond yields up by 88 basis points in the US to 4.9% by the end of the quarter, up by 52 basis points in the Eurozone to 3.2%, and by an extraordinary 182 basis points in the UK to 5.2%. Yield curves have moved to extreme levels of inversion, with shorter maturity yields much higher than longer dated yields, which is often a precursor to recession. Equity markets held up better than expected against this backdrop and were boosted by the AI boom rapidly unfolding, turbocharged by the extraordinary success of ChatGPT since its launch late last year. Megacap tech stocks in the US led the way, with the FANG Plus index of 10 major US tech stocks up by 25% in the quarter, which underpinned a return of 8.6% in the S&P 500 index, and taking year-to-date returns to 74% and 17% respectively. The dominance of US megacap stocks, both in US and global equities, is extreme, with the 5 largest stocks being Apple, Microsoft, Alphabet, Amazon, and Nvidia, together representing 24% of the S&P 500 index and 16% of MSCI World. Stripping out the impact of these huge stocks by using an S&P 500 equally weighted index reduces the returns for US equities to just 3.5% for the second quarter and only 6% year to date, which is roughly 2/3 lower than the full index return. Most other equity markets have much lower exposure to big tech and AI beneficiaries and therefore underperformed the US. In local currency terms, MSCI Europe was up 2.5% in Q2, while the UK market was down 1%. Asian markets were held back by concerns about the fading strength of the Chinese post-COVID recovery, with China down by 10% over the quarter. Only Japan of the major markets outperformed the US, returning over 14% in Q2, but the yen depreciated by 8% and eliminated the outperformance when measured in dollar terms. Bond yields, which had fallen sharply in March following the banking crisis, reversed those falls over the quarter as contagion risks diminished substantially and central banks maintained a hawkish policy bias. Yields rose across the maturity spectrum, with the steepest moves in shorter durations, taking 2-year bond yields in the US, Europe, and UK to the highest since before the global financial crisis. Unusually, in a period of sharply rising rates, weak government bond markets, and worries about economic activity, credit actually performed relatively well, helped by the resilience in the corporate sector. While US Treasuries were down over 1% over the quarter, corporate investment-grade credit was roughly flat, and US high-yield corporate bonds up nearly 2% at the index level. The key issues for markets remain inflation, the speed with which it will be brought back to target, and the damage inflicted on economies in so doing. Across the world, headline inflation is falling, but core prices continue to surprise on the upside. Labour markets remain tight, wages are rising at uncomfortably high levels, and the risks of a wage price spiral remain a worry. Navigating the trade-off between controlling inflation and maintaining financial stability while avoiding recession is becoming increasingly challenging for central banks. Despite increasingly tight monetary policy, markets have been relatively benign so far this year, surprising most investors who went into 2023 with expectations for a recession. However, the resilience of economies and continuing tight labour markets means that the battle to control inflation has yet to run its course. Policy rates have yet to peak, and it's increasingly likely that they will stay higher for longer, raising the probability of a recession to break a wage price spiral developing before this cycle can end. We therefore expect the second half of the year to stay challenging. Equity markets have been narrowly driven, and valuations of the dominant stocks, big tech, have become quite stretched. And outside big tech, valuations are more reasonable, but face increasingly tough economic headwinds as the long stretch of monetary tightening finally begins to bite. Markets don't seem to be braced for the risk of an earnings downturn and a potential hard landing of this sort. However, balancing that, the majority of the rises in rates are now behind us. The peak is in sight, and inflation is likely to fall materially in coming months. A turn in the cycle will come soon. And within months, the prospect of cuts in policy rates will re-emerge. The immediate outlook calls for continuing caution, but the sharp rises in interest rates and bond yields are generating the best opportunities in safe haven government bond markets in many years. With significantly positive real yields now available on the world's preeminent risk-free asset, US Treasuries, government bonds can again play an important role in multi-asset portfolio construction and risk control. Within our portfolios, we remain patient before adding to risk assets, and at the margin have been trimming after the unexpected strength this year, but are looking for opportunities to add to duration in fixed income, taking advantage of the attractive returns now available as we wait for the turn in the economic and market cycle, which we expect to be in sight as we enter 2024.
After a broadly positive first quarter, the second quarter of the year was more mixed for financial markets. Technology stocks saw strong outperformance thanks to the increasing excitement around artificial intelligence and its consequences on chip makers and software providers. This positive sentiment extended to other risk assets, and volatility continued to fall, as it became evident that the issues in March around the banking system were indeed a one-off event. Government bonds lost ground after inflation remained sticky, and commodities also struggled across the board. All of these dynamics affected the Harmony portfolios that posted mixed results as a consequence. The global equity and global sustainable equity funds were by far the best performers, up 5.2% and 6.1% respectively. The US dollar portfolios led the multi-asset cohort thanks to a much stronger local equity market, with growth and balance gaining 2.7% and 1.1% respectively. Notable laggards were instead the sterling balanced and growth funds, down 2.4% and 1.5%. Not only the UK equity market lagged the rest of the world, but also a stronger sterling took its toll on any offshore exposure in them. And all of the other Harmony funds posted returns in between that range. One of the top performing funds across the board was the Jennison Global Opportunity Fund, that represents more than 10% of our global equity fund, and also a smaller look-through allocation across all of the other Harmony portfolios. The fund benefited from its exposure to high-growth technology names like Nvidia, Microsoft, Apple, but also luxury names like Hermes, Louis Vuitton, and Ferrari, ending the quarter up some 11% or so. Another strong and widely held contributor was the Chrysalis Investment Trust, a private equity portfolio of about 10 high-growth, disruptive businesses. They benefited from the renewed excitement around technology, around digitization in general, and also an improved sentiment in the IPO market. Chrysalis gained about 17% of the quarter in sterling terms and really contributed strongly. Looking at negatives instead, gold, that is widely held across all portfolios, was down about 3% in dollar terms. Part of it was due to an easing sentiment around global economic conditions, but also rising real rates played a role in putting downward pressure on the precious metal. Another common detractor was the allocation to Chinese government bonds that lost about 4% in US dollar terms. The bonds themselves actually were up about 2% in Chinese yuan terms, but the currency lost more than 6% of its value against the US dollar as global market sentiment around the Chinese economy keeps deteriorating. Now, looking forward, we remain relatively negative on US equities when compared to the rest of the developed world, especially on valuation grounds, and we still prefer Japanese stocks above them all. And actually, whilst the index level US stocks had a strong second quarter, up 8%, this was actually driven by only a handful of stocks, and the broader market was much weaker than that, aligned with our view that the American economy is not in the best condition it's been in. We remain positive on rates, and we especially like very short-term bonds at 1 year or less, but also those maturing in 10 or 20 years. We just don't like that central part of the curve. We're positive that the worst of rate hikes is behind us, but we expect the business cycle to still be volatile in the coming months, and actually earnings to be those that drive market returns, as the real economic impact of a year of tightening monetary conditions shows its consequences. And so we like to remain cautiously positioned. In fact, we recently repositioned our portfolios to align them with these considerations. We reduced exposure to UK, to US equities, taking profits after a strong performance, and increased allocation to cash and long-term government bonds, both in the US and in the UK. We exited our investment in Chinese government bonds, recognizing that now the yield advantage they had over US Treasuries, for example, had disappeared, with the latter asset class now also offering a better ballast and defensiveness against any potential equity sell-off than before. And also, we added 2 new investments, 2 small allocations to music royalties, an interesting niche asset class that offers good diversification benefits and also strong upside potential in what is an expanding and underpenetrated market. And also income streams that these investments are offering are growing at double-digit rates at this stage.